You can save millions in taxes by, well, very simply, growing your money in a tax-free environment. My name is Daniel McCluskey. I train directly under industry leaders, currently serving 24 clients with this strategy. That takes place, number one, using cash value life insurance. Just like the Rockefellers, Walt Disney, Ray Kroc, the founder of McDonald's, J.C. Penney, and almost every big bank does. Because cash value inside of a life insurance policy is deemed by the IRS as insurance and not an investment, it is not going to get the tax treatment of an investment. The second step, number two, is to design a plan to overfund a policy. That means when you are using this type of policy, the same way that all these other individuals did, you are wanting the highest cash value and the least amount of insurance the IRS will allow you to have so that it is still deemed insurance. You have to fund one of these policies with post-tax dollars, and you also, to make sure you are complying with the tax codes, comply within the MEC limits. What that means is essentially, you cannot put in $10 million for $10 million and $1 worth of insurance. There is minimums determined by age, gender, and health. Any software will help you determine this. Step three is to fund the policy. If you are looking to move over a lump sum, which generally is going to max out at about 40% of your net worth, you cannot move it all over in one go. So if we're looking at a lump sum of $500,000, you cannot put all of that in 1 year and then be done. What you're going to have to do is comply with, and this is the same thing as the MEC limits, but the TAMRA premium, that's how much money you can put in a single year to reach the total number that you are trying to put in, or the guideline single premium. So if you are moving over $500,000, your guideline single premium is $500,000, but you can only put in your TAMRA premium. So if that is $100,000, you're going to have to fund this policy over 5 years. You're not going to be able to put it all in at once and get it going. You used to be able to do that in 1980 until 88, but that got to the point where banks almost couldn't compete, so they wanted to slow it, not eliminate it, but slow it because they are still using this as well. Step four, wait. These policies are not short-term vehicles. Think of it like an apartment building. If you buy an apartment building, in the first year, you're only able to fill it with residents on the first floor. Are you going to be profitable? Absolutely not. Once you get all of those other floors starting to fill up, then you are going to be optimized for profits. Specifically with some of these policies, 30 years in, retroactive back to day one, if you were just funding with a lump sum like that, you're going to be able to get the net internal rate of return within 1% of the actual rate of return. That means if you are performing at a 7% rate of return, you just earned a 6% tax-free rate of return that you can now access. And that leads us to step five, accessing the money and transferring the money completely tax-free. You're able to do this through policy loans. You're also able to withdraw everything that you put in tax-free. Anything above that would be taxed unless you are accessing via policy loans. This is the smart way to do it. This is the way that all of the people mentioned at the start of the video are doing it. Therefore, it's still considered insurance, not considered an investment. You won't have to pay the taxes. And when you die, all that happens is if you have outstanding loans, the death benefit is going to pay off those loans first, and the remaining death benefit is going to transfer to your heirs completely income tax free. If you'd like to learn more, I have loads of videos going into much more depth. Subscribe.